Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Hey everyone, welcome to a deep dive. And today we're diving deep into lower middle market lending.
Okay.
We're going to try to figure out why this is becoming so attractive to lenders. And we've got some great material to work with.
Yeah.
We've got some insights from Trevor Clark over at Brook Capital Partners.
Mm-hmm.
And we've got some data from, KDRA, LSIG, Moody's, and Goldman Sachs.
Wow. Sounds like we're going to be busy.
Yeah. So you might be surprised at what we find when we look into the lower middle market.
It really does challenge a lot of those traditional assumptions about, where the best opportunities are.
Okay, so let's get into it.
Okay.
First up, everyone wants a good return, right?
Of course.
And KBRA, they put together this chart on direct lending spreads.
Yeah.
And it's pretty interesting how much those spreads jump when you look at those smaller borrowers.
Yeah, there's a pretty clear trend there.
Yeah.
Lower middle market loans just consistently offer higher spreads compared to the core middle market or the upper middle market. So what does that mean for lenders?
Right.
Potentially better returns.
So for those who are looking for yield, lower middle market's looking pretty good.
Seems like it.
But is that higher yield just a way to compensate for higher risk?
Well, that's what most people would think.
Right.
But Trevor Clark actually has this really interesting take on it.
Okay.
He argues that in the lower middle market, experienced lenders can actually find companies that have cash flow that's as stable as the upper middle market company.
Wow.
Yeah.
So it's almost like they're hidden gems.
Yeah.
But how do you even go about finding those companies in the first place?
Well, you need a really great
Yeah.
origination and underwriting team.
Right.
You really need people who know that space inside and out so they can dig deep and spot those companies that have solid fundamentals and exciting growth potential.
So it's not just about taking on more risk to get more reward. It's about using that expertise to find the lower middle market companies that are actually less risky than they appear.
Yeah, and this is where things get really interesting when we start looking at leverage.
Okay.
We have this great chart from LSEG and TPG that breaks down leverage levels across different parts of the middle market. And what you see is lower middle market deals tend to be much more conservative.
Okay.
Leverage is usually sitting somewhere between like 3.5x and 4.5x.
Yeah.
Now compare that to the upper middle market where it's often, 5 to 5.5 or even higher.
Wow. Yeah, that's a big difference.
Yeah. And that lower leverage, what does that mean for lenders?
Right.
Lower risk.
Okay.
If a company has less debt, they've got more breathing room to handle unexpected challenges. And for lenders, that means a bigger margin of safety, reduced potential losses.
So we've got higher spreads, potentially lower risk.
Yeah.
What else is there?
What else makes the lower middle market so attractive? Let's talk about protections for lenders. Okay.
Moody's has this chart that really highlights this.
Okay.
Shows that loan covenants, those agreements that give lenders, certain rights and protections, are way more common in the lower middle market.
Interesting.
We're talking like 67% of loans having covenants compared to 38% in the core middle market and only 7% in the upper middle market.
Wow, that's a big difference.
Huge.
So if things go sideways with a borrower, lenders in the lower middle market have more options to protect themselves.
Exactly.
That's huge.
It is.
But we can't forget about diversification.
That's right.
That's another big piece of this puzzle.
It's a crucial factor that often gets overlooked.
Yeah.
Goldman Sachs put together some data that actually shows a surprising amount of overlap in the portfolios of upper middle market business development companies, or BDCs.
BDCs, okay.
And that lack of true diversification means lenders could be exposed to more concentrated risks.
So if one particular industry or sector takes a hit, it could have a ripple effect across a big chunk of their portfolio.
Right.
Contrast that with the lower middle market.
Right.
Where you've got a much wider pool of potential borrowers and a bigger diversity of industries.
Yeah.
Lenders have the opportunity to build more diversified portfolios.
Okay.
Spreading that risk across a much broader range of companies and sectors.
So for you, the listener, what does all of this mean?
Well, if you zoom out and look at the big picture, this trend toward the lower middle market signals a pretty significant shift in the lending landscape.
Yeah.
It's not just about chasing those higher yields anymore.
Right.
It's about finding a more nuanced and potentially more sustainable approach to lending.
Okay.
An approach that strikes a better balance between risk and reward.
I mean, it's making me rethink, some of my own assumptions about where to look for opportunity.
Right.
But I'm curious, if everyone starts flocking to the lower middle market, won't that increase competition and drive down returns?
That's a great question, and it's definitely something to consider. As the lower middle market gets more attention, more competition is a natural consequence.
Right.
And yes, that could put some pressure on spreads over time.
So how can lenders stay ahead of the curve?
It all comes back to what we've been talking about.
Okay.
Developing deep expertise in specific sectors, building those strong origination and underwriting teams, and finding innovative ways to structure deals that protect both the lender and the borrower.
So it's not just about jumping on the bandwagon.
Right.
It's about being smart, strategic, and really understanding the lower middle market.
Exactly. It's recognizing that the lower middle market isn't just one big homogenous thing.
Right.
It's a diverse ecosystem of businesses, each with its own unique risks and opportunities.
This has been really insightful, and we're just getting started.
I know, right?
There's so much more to uncover here.
I'm excited to see where this goes.
Me too.
I think this is going to be a really interesting deep dive.
I think so too.
You know what's really interesting about this shift to the lower middle market? Is that it kind of goes along with this bigger trend we're seeing. Like all across the economy.
Okay.
The rise of these smaller, more agile businesses that are really shaking things up in these more traditional industries.
Yeah, it's true. We're seeing it everywhere. From tech to healthcare, even manufacturing.
Absolutely.
These smaller companies, they're often the ones that are driving innovation. They're adapting quickly, and they're a major engine for job growth.
Yeah. And for lenders, this is a fantastic opportunity to partner with these companies at a crucial stage in their development, provide them with the capital they need to really scale and, become a part of their success story.
It's almost like we're seeing this whole new ecosystem emerge.
Yeah.
Where lenders aren't just providing financing.
Right.
They're becoming more like strategic partners.
Absolutely. It's a win-win situation. Lenders get access to potentially higher returns, a more diversified portfolio.
Right.
And these lower middle market companies, they get the fuel and support they need to really reach their potential.
So this isn't just some niche strategy anymore. It feels like it's becoming a core part of how a lot of lenders are approaching the market.
I think that's a very accurate assessment.
Yeah.
And this trend is only going to accelerate in the coming years.
Okay.
As more investors recognize the potential of the lower middle market, we'll see even more capital flowing into this space, which will further drive innovation and growth.
That's a pretty optimistic outlook.
Yeah.
But let's play devil's advocate for a second.
Yeah.
Are there any potential downsides or risks that lenders should be aware of as they kind of venture deeper into this lower middle market?
Of course. Like with any investment strategy, there are inherent risks. And in the lower middle market, some of the key challenges really revolve around the need for specialized expertise. The importance of really robust due diligence and the potential for increased competition as more lenders enter the space.
Okay, so let's break those down a little bit.
Okay.
You mentioned specialized expertise.
Yeah.
Why is that so crucial in the lower middle market?
Well, like we talked about earlier, lower middle market companies are often operating in these niche industries, or they have unique business models that require a really deep understanding of the specific dynamics of that sector. Lenders can't just rely on generic underwriting models or broad industry benchmarks.
Right.
They need the expertise to really assess the risks and opportunities of each individual company.
So it's not a one-size-fits-all approach.
Not at all.
It requires a much more tailored and hands-on approach to lending.
Yeah.
Okay, and what about due diligence?
Okay.
How is that different in the lower middle market?
Well, due diligence is critical in any lending transaction, but it takes on even greater importance in the lower middle market.
Okay.
These companies often have less established track records, less publicly available information, and they may not have the same level of, financial sophistication as larger borrowers.
Okay.
So lenders really need to be extra thorough in their due diligence process to make sure they fully understand the company's financials, their operations, and the management team.
Sounds like it requires a lot more, digging and analysis.
Absolutely. It's about, piecing together the puzzle, looking beyond the surface level numbers, and really getting to know the business inside and out.
And finally, you mentioned increased competition.
Yeah.
How might that impact the lower middle market lending landscape?
Well, as more lenders enter the market, it's natural to expect some compression in spreads.
Right.
They compete for deals.
Right.
And this could lead to lenders taking on more risk to maintain their target returns, which could, potentially create some instability down the line.
So it's almost like a self-fulfilling prophecy.
Yeah.
The more attractive the lower middle market becomes, the more competition it attracts, and the more pressure there is on returns.
That's exactly right. That's why it's so important for lenders to stay disciplined.
Yeah.
Focus on quality over quantity.
Okay.
And maintain their underwriting standards even when faced with increased competition.
So it's about playing the long game.
Right.
Building those sustainable relationships with borrowers and focusing on creating value for both sides.
That's the key. It's about, moving away from a purely transactional approach to lending and toward a more collaborative and partnership-oriented model.
This has been incredibly insightful. But before we wrap up, I want to circle back to Trevor Clark's point about those hidden gem companies in the lower middle market.
Right.
How can lenders identify these companies?
That's a great question. Yeah. And it really gets to the heart of what makes lower middle market lending so interesting.
Okay.
It's not about chasing the obvious winners.
Right.
It's about uncovering those companies that might be flying under the radar, but have the potential to outperform.
So it's almost like being a detective.
In a way, yes.
Right.
It requires looking beyond those, standard metrics and digging deeper into the company's story.
Okay.
Its management team, its market positioning, and its competitive advantages.
So what are some clues that lenders should look for?
Okay.
What signals might indicate a company is a hidden gem?
Well, one key indicator is strong and consistent cash flow.
Cash flow, okay.
We talked about this earlier, but it's worth emphasizing.
Right.
Companies with a proven ability to generate cash flow are inherently more attractive to lenders.
Okay.
They're better positioned to service their debt and weather economic storms.
It's all about that cash flow.
Right. But it's not just about the absolute level of cash flow. It's also about the quality and consistency of that cash flow. Is it recurring? Is it predictable? Is it growing over time?
Right.
These are all important factors to consider.
So lenders need to dig into the details.
Yeah.
It's not just about looking at a single number.
Exactly. Another key indicator is a strong management team.
Okay.
This is especially important in the lower middle market, where companies often rely heavily on the vision and execution of their leaders. So lenders need to assess the management team's experience, their track record, and their strategic vision.
Okay.
Are they passionate about their business?
Yeah.
Do they have a clear plan for growth? Are they adaptable and able to navigate challenges?
It's about betting on the jockey as much as the horse.
Precisely. And finally, lenders should be looking for companies with a sustainable competitive advantage.
Okay.
What makes this company stand out from the crowd?
Right.
Does it have a unique product or service, a strong brand reputation, a loyal customer base? Right.
Does it operate in a niche market with high barriers to entry?
Yeah, those are all factors that can give a company an edge.
Exactly.
And make it more resilient in the face of competition.
So to sum it up, identifying those hidden gems in the lower middle market, it's a combination of art and science.
Okay.
It requires a deep understanding of the market, a keen eye for detail, and a willingness to dig beneath the surface to uncover the true potential of a company.
This has been an incredible journey through the world of lower middle market lending.
You have.
We've covered a lot of ground.
Yeah, we have.
From the potential for higher returns to the importance of specialized expertise, due diligence, and the identification of those hidden gem companies.
Absolutely.
But before we wrap up, I want to kind of shift our focus a bit.
Okay.
We've talked a lot about the benefits for lenders, but what about the companies themselves?
Yeah.
The ones on the other side of these deals.
Yeah.
How has this increased interest in the lower middle market
affected their businesses?
Well, it's been pretty transformative for them.
Okay.
This influx of capital has been a game changer.
Yeah.
It's giving them access to funding that they might not have had before.
Right.
It's allowed them to, chase growth opportunities, invest in their operations, and become more competitive.
So it's opened up like a whole new world of possibilities.
Exactly. And that has ripple effects across the entire economy.
Right.
When these smaller businesses succeed, they create jobs, they drive innovation, and they contribute to overall economic growth.
So it's bigger than just the lenders and the borrowers.
Right.
It's about the impact on the bigger picture.
Precisely. And that's what makes this trend so exciting.
Yeah.
It has the potential to create a more dynamic, inclusive, and resilient economy.
So as we wrap up this deep dive, if you're an investor listening to this, what should you be thinking about?
Well, it's crucial to remember that the lower middle market isn't just this, one big homogenous thing.
Right.
It's a diverse ecosystem
Yeah.
with a huge range of industries, business models, and risk profiles.
Okay.
So doing your homework is key. Understand the specific dynamics of the market.
Right.
And partner with lenders who have that deep understanding of this space.
So it's not just about chasing the highest yield.
Right.
It's about making, smart, informed decisions.
Absolutely. And if you're a business owner operating in the lower middle market, this is a time filled with opportunity.
Right.
With more capital available than ever before, you have the potential to really fuel your growth and take your business to that next level.
But as with any opportunity,
it's
important to approach it responsibly.
Right. Choose your lending partners carefully.
Okay.
Make sure you have a solid plan for your business.
Right.
And be prepared to demonstrate your ability to manage that growth effectively.
So to bring it all together, this rise of the lower middle market, it's a powerful trend. It's reshaping the lending landscape.
Yeah.
And creating opportunities for both lenders and borrowers.
It's driven by several factors. The search for yield, the emergence of these, dynamic smaller businesses, and the understanding that diversification and risk management are more important than ever in today's economy.
And like any dynamic market, there will be challenges and risks along the way.
Of course.
But for those who approach this space thoughtfully, strategically, and with, a well-informed perspective, the lower middle market holds the promise of some significant rewards.
It does.
This has been a fantastic deep dive.
It has.
And I hope you, our listener, have gained some valuable insights from our conversation.
I hope so too.
Thanks for joining us on this journey.
Thanks for having me.
Until next time, keep diving deep.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.